Let's get your home loan rate down. We understand how important managing cash flow is for investors. That's why talking to one of our brokers can help you find the best loan options and a better rate. Your Finni loan expert will assess your loan and quickly spot a better option if it's out there. With access to over 70 lenders and a wide range of products, you're sure to get the lowest available rate in the market. Stop worrying about your repayments now and take charge of your financial freedom. Contact a Finni mortgage specialist today on 02 8866 2444 or visit our website at www.finni.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hi, good everyone. How you going? Phil Tarrant, host of the Smart Property Investment Show. And here we are again when we chat through mortgage finance, how you use mortgages as an enabler to grow your investment portfolio, how to make sure you're getting the right product at the right rate and the right structure to continue investing in property. I've really enjoyed these conversations over 2023. We really started digging deep into this halfway through the upwards rate cycle phase with a lot of feedback coming in, people going, what do I do? I'm stuck. I'm in this mortgage prison. I can't refinance. I can't do this. I think I can't invest any further. I don't know how I'm going to afford to put food on the table. I'm coming off fixed rates on the variable rates. What do I do about it? So we decided to focus and get together a couple of times a month with the mortgage broking crew over at Finni Mortgages to get some sense of it all. Joining me in the studio, Loisance, the head broker, principal broker over at Finni Mortgages. We're going to get stuck into it today, and we're going to recap on something because people are going, I didn't get it, but it sounds really, really good. What do I do about it? Eva, how you going? You well?
Yeah, great. Thank you. I'm really excited to talk about this one. It's saving a lot of money and getting people out of that mortgage prison you mentioned. So, really excited for this podcast. Yeah.
Yeah. So, here we are towards the top or at the top of this rate cycle. Everyone is still sort of coming to grips with the interest rate rise at the start of November during the Melbourne Cup, which a lot of people weren't expecting. And then sort of running up to the race, they went, oh, hang on a sec, interest rates might also go up. And they did, on pause in December. And again, there was nothing that RBA doesn't meet in January. And there'll be a different cadence of when the Reserve Bank meets in 2024. So less chances for them to raise rates. But the consensus is we're at the top or largely at the top of this interest rate cycle. So now it's about configuring your mortgages on the basis that hopefully they shouldn't go up any higher. And most economic forecasters are indicating that there will be some sort of rate reduction, some cycle commencing towards the back end of 2024 and into 2025, if you're going to follow what's happening in America and other Western nations, what their central banks are doing. So you've got a mortgage or you've got numerous mortgages and you want to make sure you're paying as little as possible on top of it. Eva spoke about this notion of the mortgage prison, which essentially is you're stuck with the loan that you've got because you can't refinance it because you don't meet the serviceability requirements of other lenders. That's the idea of mortgage prison. So you've got to stay with the bank or the lender that you currently have at the interest rates that they're charging you. You can get on the phone and give them a call and say, Mr. or Mrs. Bank, I'd like a reduction. Otherwise, I'm going to move my mortgage somewhere else. They might give you a little bit here or there, or they just go, nah, no way in the world, because I know you can't refinance your loan anywhere else because you're at the top of the serviceability ceiling. So you got to pay what I'm going to charge you. So people get stuck. They can still largely afford their mortgages or make the repayments, albeit maybe with some stress towards the family balance sheet, but they can't move it. The mortgage isn't portable. And what mortgage brokers can do really well is help investors and owner occupiers with mortgages move their mortgages to better rates. And that's one of the key principles of how mortgages brokers operate. So Eva, there is a thing though.
Yep.
So you can move your mortgage because a lot of banks view a refinance different to taking on new debt. And this is where traditionally there's been this buffer, circa 3% on serviceability. So what a bank will do is that they'll look at your serviceability rate and then they'll add 3% to the mortgage and see whether or not you can still make the repayments. And they go, yes, you qualify for a loan. Some lenders, if you're refinancing, don't take that whole 3% buffer and they reduce it and therefore help you move your mortgage. And that's what we're talking about here, isn't it?
Yeah, that's the whole, I guess, magic of it. So that this came only back in July this year. And it's changed a lot since it first came out. There's more lenders on board now and more options for, I think, investors. And I think that's where I want to dig in today is the investors that are either coming out of fixed rates or the interest only period finishes and they've just been told no everywhere they went. Because even though on paper they're actually making money off those properties, with all those buffers that are applied in the bank servicing calculator, it just shows us, there's like a deficit every month because of all those buffers. But there is now this option of the 1% buffer that will literally save investors from being stuck, being in mortgage jail, and even invest again if that's what they want to do.
Quick question. It's sort of connected in this idea of mortgage prison or mortgage jail. There's probably two bits to it. One is if you have your loans cross-collateralized, and we've spoken about this beforehand, it's going to be really hard to move them if you are stuck in this space. So, that's a complete restructure of your portfolio. But the other side of it is a question for you. If you've got one asset, so one property, and you have two loans connected to it, so an interest-only component of it, and then also a P&I component of it, which may be fixed, right? So two loans against the one security. If you want to refinance one of them, you need to refinance all of it. You can't refinance one. You can't refinance the fixed part of it with one bank and keep the variable part with another bank, right?
The bank won't share the properties. They're not that nice with each other, I guess. So if you move one, you have to move everything. You have to move everything that is attached to one property together. Yeah.
Okay,
so if it's cross-collateralized, and if it's cross-collateralized, then you literally have to move everything in one go. But that's also the opportunity for people that have properties that are crossed to uncross them while refinancing and making sure every property stands alone.
Yeah, it's a bit of hard work to do it. Yeah, it's worth the
it is hard
pain.
work, and you might have to chip in some money, but it will, in the long term, it's really worth doing. Saves a lot of issues with selling.
Yeah. That's best to do it before you need to do it as well. I'll give you that hot tip. So this is sort of investors with interest-only rates about to finish, or they may have cash flow issues as stuff move on to principal and interest, or investors looking to buy their next property and they can't service it or they can't access the equity. So that's another important point. So you've got equity in the loan. You want to get it out, but you've got to refinance it in order to get it out with a different lender or the same lender, but they won't do it because you don't meet the services. So it's complicated. So there is this sort of special refinance buffer. We'll chat about it. Just stay with us, everyone. Go to a quick break. Back in a moment. Welcome back. Phil Tarrant from Smart Property Investment. Having a chat with Eva from Finni Mortgages. Finni, Finni. I got that right, .com.au, Eva. So a lot of your clients get told no before they come to you, and then they come to you and you can say, let me try and find out how I can turn this into a yes. As we come up to Christmas, we still have some time potentially. How do you go about doing this? At this 1% buffer, they just remove 1% off the buffer rate, so it reduces your serviceability equation?
Yeah, so instead of putting a 3% to all the debts you've got, so 3% on top of the rates you would be paying, we're only applying 1%. So let's say if you are minus $2,000-$3,000 on the calculator a month, it might just actually put you in the green light to refinance. What's changed a lot in the last 6 months since this idea of the 1% refinance came out is it has to be dollar for dollar. It has to be, you have to refinance to principal and interest. Had to be, you are an employee, not self-employed. Had to be, if it's 23 years term remaining, you have to stick with 23 years. It really opened up now, and you can refinance on interest only. You can refinance for 30 years. Self-employed are, happy to be considered as well. So there's a lot of things that happened in the last 6 months that are now more, targeted for investors struggling to, either refinance their portfolio because they're struggling now with the high interest rate, or because they reverted back to principal and interest repayments. So that gives them an opportunity now to look at this option. And what happened as well, that's quite important. It used to be dollar for dollar. So if your loan is $523, it had to be $523, not a cent more. Now there are some lenders that will allow for up to $50,000 cash out. And that can be your ticket to, quite a bit of money to put towards the next property. Combined with savings, that can be enough to get going.
That's a really interesting point. So this has been around for 6 months now, but it was pretty limited and restricted. So you had to be employed doing this, that, and the other, as you mentioned. So now they're saying Okay, well, let's make this more open. So just so I'm correct, so it's 1% on top of the interest rate. So is that based on the standard variable rate of the bank, or is it the standard variable rate less any discounts plus 1%?
Yeah, so it would be 1% on top of the actual rate people would be paying. So it's a standard variable rate minus discounts that you might get plus 1%.
So if you're getting 6.5%, which is sort of what a lot of investor finance is at right now, essentially they'll do your serviceability equation that the rate is at 7.5%.
Yeah, correct.
Okay. All right. I'd like to simplify things. I'm not that bright. So
instead of 9.5, which is huge.
So 2%, 2% on $1 million, right? It starts, if that's, I'm just trying to use an easy number there for my simple calculations of math. Okay. So I get that. That makes sense. And I think this gives you a sense to competitiveness of banks, right? Like banks want to lend money. They need to be comfortable and satisfied that the rate environment isn't rising at the same speed as it has done. They've got some very bright boffins that'll tell them that they're pretty much at the top of the interest rate cycle. So therefore, they're happy to lend out money on that basis, knowing that hopefully someone should be able to repay that debt rather than accelerating up. That's the reason why they always had this 3% buffer, which I think was prudent. APRA put it together, the Australian Prudential Regulating Body, pretty much saying when interest rates are all-time lows, we're going to do a 3% on top of that because rates will rise. It makes sense. But now they don't have that buffer as high as what it is. But this is the innovation you need to see.
What's actually interesting now is people that were assessed on 3% buffer plus a year ago, when they were on 2%, they're actually now paying more than they were assessed on 12 months ago. And that's where we actually see people struggling, that the RBA went so high that whatever we thought the rate would go to a year ago is so far off what's actually happening. That's where, investors and owner-occupier, first-home buyers, that's where they're struggling when 3% we thought was a lot of buffer, but it wasn't. So
it's just, how long will we be at the interest rate?
High,
when's it going to start coming down? And maybe at the end of 2025, it might get to the point where it was when people took on this debt, which was maybe 2% mortgage, 3% buffer, 2.5% mortgage, 3% buffer, 5.5%. It'll hit equilibrium somewhere, but that's way outside my pay grade to even try and work that out. But it's what do you do about it, right? So if this sort of resonates with you and you're going, God, my principal place of residence, it's stuck with the bank. I'm not happy with them. They really annoy me. They've been intransigent. They don't want to negotiate. They blah, 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 blah. Guess what? You can actually do something about it now. You can refinance. You can get out of that mortgage prison if you're upset or not satisfied with your current lender and you haven't been able to move it structurally. Now you might be able to do it by considering this with this 1% refinance buffer on top of it. And you're going to see innovation, further around this. Obviously, the regulator, APRA, is happy for the banks to do this. So APRA must have a level or degree of satisfaction that interest rates aren't going to keep climbing at the rates that they have done. But how do you do it and what do you do about it? Let's chat about it very quickly, Eva. We'll go to another break beforehand. Stay with us, back in a moment. Welcome back, Phil Tarrant from Smart Property Investment, chatting through this 1% special refinance buffer with Eva from Finni Mortgages. So just to reiterate, you can switch or move your mortgage if you feel as though you've been stuck with your current lender. You may not have been able to meet the serviceability requirements with a 3% buffer on top of the standard variable rate offered by banks, and therefore banks won't provide you new tranche of financing to refinance your loan. Some banks, some lenders now will just put 1% on top of it as the buffer rather than 3%, which can really be an enabler to potentially help you reduce the serviceability numbers and therefore move your mortgage. That's what we're talking about right now. Eva, how do you go about doing it? Is it just a simple refinance?
No, so it's not actually a simple thing to do. It's a normal refinance. They call it simple refi because it's obviously easier to refinance. There's still strict, criteria. You really must have zero arrears or late payments on all your mortgages or credit cards or whatever you may have. You must be like the squeaky clean client. If you got anything, even if it's one day late on one of your loans, that's a no. You'd be declined right away. So it has to be squeaky clean refinance application. The good thing about it is even though you're getting a bit privileged there, getting 1%, there's no buffer. You're not paying more on the interest rate later on to have the privilege, of being assessed on a more favorable assessment rate. So in that sense, it's easier to get approved, but the application itself is quite strict. So you have to make sure, you haven't got
So
any defaults there.
there's zero
Yeah.
forgiveness at all. So like
Not zero tolerance. Yeah.
how long do you need to be squeaky clean before the bank's happy to go?
12 months.
You got to be 12 months. God. So
Yeah.
I was looking at, I missed by a day. I forgot to move some money into an account on one of my mortgages that gets direct debited from by, I was about
Sorry, Phil, not for you.
I was about $10 short of what the interest repayment. So the bank withdrew everything it could from the account, bar $10, right? Because I just forgot to move money into it. So that means that's it for me. Like I can't go, oh, come on, guys. Like I just forgot.
No, for 12 months.
12 months. It's like a fine, isn't it? It's a penalty. So
yes.
So I'm out of the action.
So I guess it's not for struggling customers that have not been able to make, I guess, their repayments. If it wasn't your case, I guess, it was just a mismanagement of funds. But if people have, been late or can't afford actually their mortgage, that's not for them. It's really for people that are paying too much and just don't need to. There's other options there.
Yeah. Well, I think the point here is that make sure your administration is watertight, because I would argue the bank going, hey, look, Mr. Bank, there's another offset here with heaps of money in it. Like I've always got the money. I just forgot about it. Like, come on, cut me some slack. It just won't work. It just won't work.
No, that's a very, very strict condition. And look, I've tried with similar stories to yours, and it's just a plain fat no, not happening.
It must be some requirement from APRA, right? Because I reckon the banks go, oh, he's all right. He's banked with us for 10 years. He's pretty good. Look at his history. We'll let this one slide to the keepers. So it must be still regulated pretty heavily, I would imagine.
Yeah. So, there's not that many lenders that do it, like 6, 7 now, and they all have different rules that are still pretty tight. Most of them, you can't really get any more than 1% cash outs, just a small buffer to cover the fees, but that's it. It's only like Westpac and St. George that will allow for up to $50,000 cash out.
Do they want to know what you're doing with the money?
Yeah.
So if you just go, I'm going to spend it on an overseas holiday, they go, no, or they go, yeah, sure, no worries.
No, look, I guess you can do what you want with the money, but they do want to know what's happening. With it.
Nosy banks, they need to know too much. Makes me nervous. So there should be rules for everyone else, and there should be rules for me, I reckon. Is what we said to all the lenders out there. We've got to accommodate my misadministration of my mortgages sometimes. But to be fair, what I'm getting at here is that you don't always get it right. Like everyone I know sort of stuffs up every now and then, and not having enough money for a direct debit in your mortgage is pretty 101 stuff, and it shouldn't happen. And I remember looking at 3 days before saying, I need to move that mony over there because I know these repayments going out, and I missed it. So
yeah. Anyway. And unfortunately, that would disqualify you for this if if you wanted to apply. Unfortunately, the good thing about it's getting more flexible and lenient, as we've seen in the last few months. And we now have the option to also do it for purchases, which we didn't have before. So people can also buy property on a smaller buffer. And that gets, investors quite excited so they can buy the next property. That wasn't the case, 3-4 months ago. And now we've got lenders coming on board for low doc loan.
A low doc's back.
Low doc back on a 1% buffer, which seems a bit
low docs on 1%
out there.
Oof.
Yeah, so that's
bring it on, everyone. Bring it on.
And SMSF as well.
And I've been saying it for quite some time. What you need to start looking for are these signals that are going to sort of shape property market activity. And one of them is about access to money or liquidity. When you start seeing the access to money, access to debt becoming a little bit easier, as in less regimented or restricted, is one of the triggers you need to be looking at. And I think what you're seeing here are green shoots of that, where access to money and the rigor around it is starting to come back a little bit into the favor of the investor or the purchaser or the person taking on the debt. So the fact that you can get low docs with a 1% buffer on the standard interest rate is, again, you're starting to see that this is what you need to start looking for. So, and there's an argument to say whether that's good or bad. There would be a whole bunch of the cohort of Australians would be saying, well, this is bad because it means prices are going to go up. Again, because more people have more money, therefore they're going to keep pushing prices up. Let's remember this is a podcast for property investors. So most of us, I don't know anyone who invests in property hoping that their real estate value goes down. All right. So it's a friendly audience. But we only saw yesterday And it's something for people to be conscious and aware of. And I'll do something around this. I'll find someone a lot smarter than me to talk about it. You've seen indications from the government that they're going to be changing and shaping immigration moving forward and temporary immigration. And I heard some stat that about 10% of the Australian population is temporary. Australians are on some sort of visa. What they're going to try and get to is trying to curb this perpetual extension. So they call them permanent temporary Australians. And this is a lot of the logic around immigration about shaping housing affordability. That's where they're going to target it. I don't yet have a full view or opinion on the policies. I don't know enough about it, but you're going to start seeing changes to migration, how that will influence property prices. But on the other side of the ledger, you think about, to my point, around these green shoots of access to finance starting to become a little bit easier for property investors is going to be a major and significant impact or factor that will shape property markets. So anyway, we probably need to do an update on all that from a macro and microeconomic point of view and get some sense of it all. So stand by for that. But if you can get low docs, okay, that's fine. And for those people who aren't familiar with low docs, is that it's not really a full serviceability assessment. Lenders will overlook certain things in order to provide the debt to you, often at a much or a significantly higher rate than what it would be under a full sort of serviceability criteria. But if you haven't got your financials sorted out, if they don't look that great, if there's changes happening in your life or you're self-employed and you might not have structured your finance for the purpose of securing debt, it could be a great way to enter or to continue investing in property. That said, though, just because the debt is available and you can access it and the bank will make it available to you, you need to be responsible on whether you take it on or not. You can't sit there in 2 years' time saying, I can't afford this debt. The bank should never have given me this money. It's all their fault. No, you got to take responsibility. If you take on a debt, you're accountable for it. It might be available and you can find professionals that will help you out to secure it or work it out. People like Eva and at Finni Mortgages. But you need to make a decision on whether you take on the debt. So be responsible. Don't blame anyone else would be my 2 cents of it all. Eva, I like the sound of it though. So is your team, I know Christmas just around the corner, you guys happy to even start this process for people at the moment?
Yeah, look, I think it's actually a good time because people that have purchased property looking to settle before Christmas, it's sort of that wave sort of passed now. And we do get new inquiries for people looking to purchase in the new year or want to get their finance sorted for the new year. So it's a really good time there where we can lodge the application. It will go through the Christmas break and we'll get an answer very early in Jan. What most people do is they wait, contact us mid-Jan, and then it's, what everyone does, and then you have to wait quite a bit. So it's actually a good time to get it sorted. On your point there, it's the 1% also is applicable to SMSF. So that's another big one where people may, had properties in SMSF for quite a while and things change, job change, and they can't service anymore to refinance. Those interest rates for SMSF that have been set up like 5-10 years ago are like crazy, double digits. So definitely worth looking at those. And also to your point of lending becoming easier, it's actually opening up doors for temporary residents and permanent resident quite a bit too. So it's interesting to see.
Let's have a chat about that one a little bit later on. That's good. Best way, finni.com.au, finni.com.au is where people need to go, Eva.
Yeah, finni.com.au. We'll be in touch, set up an appointment at a time that suits everyone and discuss through, people's specific circumstances.
So I think I'm about a day away from finishing my refinancing journey, I'll call it that, with Finni and your very good broker, Rebecca Carlson. So I think I'm signing documents tomorrow on all that, which is good. And that's been quite I don't know how many loans refinanced, but Rebecca's been very patient with me. So I'll be able to talk about that once all that's sorted out. So stand by. I like talking about mortgages. It's pretty important, is what powers most people's property portfolio. Remember to go and check out the guys and girls, finni.com.au, finni.com.au. You can do it before Christmas. When's the best time to start? It's now. If you like the sound of this thinking you couldn't refinance your loan, well, it's just 1% special refinance buffer. Go and check it out. Thanks for tuning, everyone. Remember to go to smartpropertyinvestment.com.au. Heaps of information. Smart Property HQ social media is where you find us. Lots of other podcasts. So you can binge over the Christmas period. Hope you enjoy. Until next time, I'll see you later. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Do you need help planning your next event? With over 15 years of experience, Captivate Events is the expert in event planning. Our dedicated team ensures every detail is meticulously handled. Whether it's a gala dinner, exhibition, conference or study tour, we've got you covered. We'll be there every step of the way, from conceptualisation to flawless execution, to ensure your event is a seamless experience, minimising the time and stress involved in planning. Make your next event one to remember. Visit www.captivateevents.com.au or call 02 8866 2440 and find out how we can captivate your audience.